Hi, this is Roger Conrad. I'm editor of Utility Forecaster. What I want to talk to you about today is really profit through panic, one way to describe it. You know, we spend a lot of time in Utility Forecaster talking about businesses, business strength, risks to businesses, and in particular as it adds up to distributions. I've done this again in the June issue, which you'll be receiving shortly. Will be posted on the website, I believe, a week from Friday. And what the kind of work that I've done in there is basically two things. One, talking about earnings, and in particular how that affects dividend coverage, the strength of the underlying core business, and the potential for growth, and then debt leverage, and in particular refinancing risk. One thing a lot of these companies did that really helped them in 2008 was to dramatically de-lever their balance sheets and take the risks out of their operations. This was in a large part due to the necessity in the crisis that followed the collapse of Enron. The utility industry at one point had something like 24 companies on the brink of bankruptcy following the Enron, and some of them did go into bankruptcy following the evaporation of Enron. And at that point, management, and a lot of it was new management coming in, a lot of the old management left, a lot of the new management, which I call the class of '02, dedicated itself to cutting the risk out of running these companies. That meant cutting debt, cutting operating risk, and so they went about doing this for a course of about 6 years. When we hit 2008, they were the mirror image of the banking system, which was fat, levered, didn't know where all the bones were buried, and so forth. But the utility industry, on the other hand, very clean balance sheets. So the utility industry, like everybody else, all these stocks went down during the crash. The businesses, though, hung together. The distributions continue to be paid, and the industry has emerged stronger than ever. So what have they done in the years since roughly when the market bottomed in March 2009? Well, they've taken advantage of very low interest rates to further delever, to further push off refinancing risk. And this is really an extraordinary thing I don't hear a lot of people talking about, but it gives me a lot of confidence, again, to hold these things. And that's really regardless of whatever turmoil lies ahead. And that's really what the fundamental question is for you as an investor, as an income investor. It's not so much whether these things can go down if there's enough fear and panic in the market. You know they can. We saw that happen in 2008. Question is, can they hold together as businesses and then ride it out and come back up the other side as they did in 2009? And the answer is even more emphatically this time around that they can, and which I think is, again, extremely comforting for holding them. It also makes it a very good opportunity to buy some of these things. We can't buy blindly. We have to keep following earnings. But again, as long as the earnings are strong, first quarter was very strong for pretty much all our companies, it's a good time to buy. And that's exactly what you'll be reading in Utility Forecaster going forward. Thanks for tuning in. I'll look forward to chatting with you next time.